The US Federal Reserve at its meeting on March 20th left the key lending rate unchanged, as was expected by the market. Following the announcement, all eyes were on the US Fed's dot plot to look for signals on the next rate cut. This next story explains what a dot plot is and why it's important now. Take a look.
In the world of finance, numbers and graphs can help economists understand the state of economies better. Now, the Federal Reserve is turning to something called the dot plot to think about its future interest rates. The dot plot is a graph that indicates how many times a particular value occurs using dots. The scale of the chart is fairly simple and used to represent small sets of data. The Federal Reserve's dot plot indicates what the members of the Federal Open Market Committee or FOMC believe should be the appropriate interest rate over various time periods. Since the highest number of Fed officials believe the lending rate should be around 75 basis points lower, the markets are pricing in rate cuts of 25 basis points over 3 meetings. In the past 4 meetings where the federal funds rate was raised, it was increased by 25 basis points. Therefore, the market is expecting that on the way down too. Given that the inflation is still high by historical standards, market feels the Fed will be wary of big cuts in interest rates. While the dot plot helps economists and investors access the extent of rate cuts by the Fed, it hasn't always been indicative of what the Fed will eventually commit to. So just like every other forecasting method used in the financial world, the dot plot graph must be read with acceptable variations. Bureau Report, WION World is One.